one of the things that you have to realize is that people are vary in their risk when you're giving them a loan. And if you give people who are high risk a loan, like they're probably going to default. That's why banks are so careful.
Absolutely.
On the
That's
one,
why they charge higher interest rates too. And the
exactly.
theory is they'll have more loan losses on those riskier loans, so they should charge more to cover those losses and still hopefully make a profit.
Right. Just to be clear, that's they charge higher interest rates for people who are riskier.
Correct.
So one of the best, I guess, easiest metrics to see is your FICO score, which says, if it's above 750, these people are prime borrowers, or above 800 super prime borrowers. They're going to have the lowest interest rates. And then people below that are going to have much higher interest rates, which means that they're going to pay more over the life of the loan. But the banks do a really, really good job of checking and making sure that you are who you say you are, and that you make as much as you say you do, and getting all these factors about your life and making decisions, especially if you're applying for a business loan, making a decision about whether or not the business sounds feasible.
Absolutely.
Some
And it's particularly, you think back, it always makes me think back to the financial crisis. On the mortgage side, subprime mortgages, no documentation loans, no income verification loans. And we all know what happened. I mean, those loans were not repaid with any sort of regularity, and it caused these tremendous losses at the banks that almost, tipped the entire global economy over. And then you read at some of these online marketplaces that what they're verifying is a lot of times even less than what was being verified for those subprime mortgage loans. I've got a number here for you. And Prosper Capital's S1, Prosper is currently it's privately owned, but it's an online
right.
marketplace
And
lender,
just so
just
you
like
know,
Lending Club or On Deck.
an S1 is what a company has to file with the SEC before they go public.
Correct. Correct. Thank you. According to their S1, which they filed earlier this year, Prosper verified employment and or income only on 59% of the loans on their marketplace, just 59%. So in theory, that means 41% of these loans, these individuals could have just popped on the website, made up a bunch of stuff, and then walked away with a pile of cash,
Yeah.
which that's fraudulent, of course. But from an investor perspective, that's a lot of risk that these companies are taking on, lending out huge amounts of capital. The thing about lending money is not only do you have to sell the loan, you also have to get it back. And that's fundamentally different when you sell a widget or some other kind of service. If a bank or a lender doesn't get their loan money back, that bank or that lender is going to fail pretty doggone quick.
So I think even more horrifying than the fact that they only checked 59% of the loans is, of those 59% they checked, they pulled 15% of the listings, saying
That's right.
15% weren't real or weren't good listings.
That's right. Of the ones they checked, 1 in 6 was wrong or
That's a
fraudulent
lot.
or just fabricated.
That's a lot. And that, like, the chances of that happening at a bank are so, so much lower.
Especially in today's environment with Dodd-Frank and all these regulations, know your customer regulations. It's a real serious thing,
Yeah.
and it's one that banks have perfected. Banks have been doing this for literally thousands of years, and there's value in that institutional and kind of cultural knowledge in the industry.
Yeah.
But that is to say, I don't want to be too negative. I really like the concept of using the internet and using peer-to-peer as a channel to enhance people who need credit and are maybe a subprime but are still willing and able to pay. Improving the access to credit can go a long way to helping these individuals' lives, and an investor who's in a company that's doing that effectively and taking the proper risk management steps. There's a lot of money to be made. I was reading a Price Waterhouse Cooper report last week as all this news was breaking that predicted that the online lending marketplace, industry, could reach $150 billion in originations per year by let me make sure I say the right year, by 2025. And that's a huge number. But that huge number only represents 10% of the current revolving consumer debt market, plus 5% of the non-revolving market. I mean, this is a gigantic ocean where these guys are playing. It's a kind of market that, if disrupted properly, there's a lot of money to be made. It's just at this point, I think they're failing on the risk management front, and so we're just not quite there yet.